Hello and welcome everyone to this webinar presented by both CRU and CME Group. It's our pleasure to host you today. Steel price volatility, particularly in the US market, has increased significantly in recent months and years as opaque policy decision-making processes and inelasticity of domestic supply have led to a large variation in physical market price. At the same time, volume and open interest on the CME Group's hot rolled coil futures and options contracts settled on CRU's US Midwest hot rolled coal price, or the CRU, has surged as the physical market has looked to manage price risk. So this webinar from CRU and CME Group identifies the reasons for the US Midwest hot rolled coil price volatility, suggests it's here to stay, and presents options for both understanding future market fundamentals and therefore price and managing price risk now. So here's a legal notice which you can read at your leisure if you request the slides later. I think CME colleagues have a similar one later in the presentation. But let's get straight on to some introductions. Firstly, let me introduce myself. So I'm Chris Holden. I manage the finished steel team at CRU. I've been at CRU for around 12 years. Before that, I worked for a major steel producer, so I'm from the steel industry. Josh, perhaps you could introduce yourself now?
Sure, thank you, Chris. Josh Spores, and I'm at CRU. I'm the editor of our monthly Steel Sheet Monitor as well as Steel Monitor, and I cover North American flat products from sheet to plate. I've been at CRU now for 6.5 years.
Great, thanks Josh. And Sean at the CME.
Hello everybody, my name is Sean Kessler. I'm the manager of metals products at CME Group. I've been in the metals industry for close to 6 years, and I've traded futures and over-the-counter products across various different metals markets, the base, precious, and ferrous, as well as various exchanges. And I've been with CME Group for about 1.5 years now.
Great, thank you, Sean. So let's get straight on to the agenda, which looks like this. So firstly, I'm going to talk fairly briefly about hot rolled coil price volatility in the physical market and some of its causes, with a bit of a focus on North America. After me, Josh is going to take a bit of a forward look. So what are CRU's price forecasts and expectations for volatility and price going forward? And then Sean is going to speak to some of the options, no pun intended, for hedging price risk in this market. And then at the end, we can have a Q&A session. So firstly, let's have a look at the causes of price volatility. And let's start with a bit of a global look. Even though we're mainly talking about US Midwest hot rolled coil prices today, I should point out that the factors driving steel prices up and down are mainly global, and there are many of them. So, for example, prices started to rise in February this year, and that was in part as a consequence of Vale's tailings dam collapse and the subsequent suspension of production at its southern system and southeastern systems. So for US steel producers, that spelled higher iron ore pellet and scrap costs and higher Brazilian slab costs for a number of re-rollers. So there are other sources of huge uncertainty for steel prices, driving prices both up and down, and I've included a few of the main ones on this map. For example, the slowing economy and the impact of structural reforms in China, economic crisis in Turkey, and economic slowdown and political turmoil in Europe, including the huge uncertainty caused by Brexit, although that's not the subject of today's webinar. Instead, I'd like to focus on the particular case of price volatility in the US market. So firstly, an observation, which is that volatility in the US Midwest hot rolled coil price increased particularly markedly in 2018. So one measure of this is the standard deviation in the weekly data points of the CRU, and this standard deviation increased from $19 a ton in 2017 to almost $75 a ton in 2018. And you can see that in the chart here by the widening of the yellow band around the price, which represents the standard deviation over the previous 52 weeks. So why has this happened? Why did this happen? Well, one of the main sources of volatility in commodity prices, including hot rolled coil, is short-term inelasticity in either demand or supply. So unanticipated changes in either that are not immediately matched by the other generate the potential for a large variation in spot price at least. And on 8th of March 2018, a form of physical market supply disruption came along in the form of confirmation of the extent and degree of Section 232. In other words, a 25% tariff on all steel imports to the US from the vast majority of countries of origin, and in addition to any pre-existing anti-dumping or countervailing duties. So this was significant in terms of the level of the tariff, and considering that before the introduction of Section 232, around 20% of market supply to the US was in the form of imports. At the same time, domestic production was not able to increase, at least immediately, in response to a reduction in import volumes. So operating rates of US-based electric arc furnaces serving the flat products at that market at that time were for the most part already high due to good domestic demand around that time. And that meant that the most responsive potential source of domestic supply was in fact already somewhat constrained. Meantime, BOF-based production was certainly unable to respond immediately. Blast furnaces typically require 2 to 3 months to bring back online, and up to 4 months before they are producing usable iron, assuming sufficient raw materials are available from stock in the first place. Also, decisions to bring back idled basic oxygen furnace-based production were not immediate. Some level of certainty about future market conditions necessary before making a call to restart. So certain idle facilities were therefore restarted, but after some delays, while there were no greenfield developments planned specifically in response to this new pricing environment, in part due to the hesitancy to make large investment decisions then, given forward policy disclarity. So this lack of supply response was exacerbated by low inventory levels at the time in comparison to shipments and resulted in market tightening. So while the Trump government's general trade policy stance was already clear and the market had begun to price in additional protectionist measures, specific detail had not been announced until March. Therefore, price rises, which had been ongoing since November 2017, accelerated rapidly in March 2018 when the extent of the action and the tariff level became known, with a near immediate jump in US domestic prices to international levels, plus around $100 per ton in logistic costs, plus a further 25% as shown here in this slide. Yet despite the March announcement, uncertainties remained around policy specifics and consequences. The possibility of further geographical exemptions and exclusions for slab, potential demand destruction, and simply the duration of the policy. So at the time, CRU commented that there was chaos swirling around the President's decision. These questions, like before, seem difficult to assess in the absence of good visibility of the decision-making process around the specifics of trade policy. So therefore, a disruption to supply and the wide and variable consequences of it were themselves determined by policy formation and decision-making processes that were also unpredictable. An example highlighting this was when, to the surprise of established trade partners, the US extended its exemptions from the 25% tariff on steel products for Canada, Mexico, and the EU 2 months later at the end of May. Another way of looking at price volatility is by taking a look at the range of prices across the year. So this chart shows prices in 2018 in the yellow color compared with the previous year in blue, and this measure increased significantly from $83 a ton in 2017 to $330 a ton in 2018. You can see the much wider spread of price range last year. So part of this variation was the run-up in prices and the heights from which they then ultimately had to fall. So eventually additional domestic supply did come on stream, mainly from existing assets being worked harder, alongside falls in international steel prices, this resulted in domestic US Midwest hot rolled coil prices falling, sometimes rapidly, from around August. From peak to recent trough, these totaled $250 per ton, unwinding most but not all of the Section 232 fueled increases. So these developments, and those which have started to push prices back down more recently, demonstrate that price volatility and its fundamental causes are not going away anytime soon. So I'd like to now hand over to Josh, who will take a forward look at both price levels and this volatility.
Yep, thank you, Chris. To start off, yeah, certainly the title of what I'm looking at is how future volatility plays into our price forecast. And the chart that I have on the left shows our price history back from 1980 onwards. And it's pretty visible that since 2004, volatility has increased dramatically. In fact, the average, or the mean listed here in the chart, has doubled from 326 to 623, which ironically is the exact same number, just backwards. In the meantime, standard deviation and the range have each tripled. And that's quite clear in this chart here. The 10-year average is one thing that we look at. A lot of times you can see prices revert back towards that. And if you look at this average, this is more than the 10-year, but it's closer to a 15-year of 623. It's important to just realize what that's saying about prices versus our most recent price assessment on Wednesday of 691 a short ton. It's saying that prices are supported. Obviously, that support is from the Section 232. On the next slide, I did take a look at some of the questions our listeners here today put forward to us, and one of them was asking for some sort of scenario, not just our actual forecast. And so I tried to model this out in terms of understanding what our forecast is, what it's made of, along with a couple other options here. And to take you through this, the current forecast, which I'll get to in a moment, our current forecast is influenced by changes in our cost curve longer term. So it's the steel raw material costs as well as supply into the market bounced up back off of demand in the longer term. In the short term and the near term, we provide more influence to our prices based on changes in supply, demand, and market sentiment or market psychology. Adding to this, I have looked at the long-term average with the standard deviation as a guide in terms of where prices may go. And then lastly, I've got input from a model that uses, I try to understand what a fair value of the market is. And to do that, I look at global prices as well as a cost approach based on the marginal source of supply. So on the next slide, I have our current forecast. So you can see here, our current forecast, we see a falling trend through 2023, and this is primarily due to rising capacity and then some expected evolution of the 232. It's a challenge for us to forecast prices and the inclusive volatility. This is a great chart showing from 2015 through 18, where the low was $354 a short ton for hot rolled coil, and then the high was $918. It's a massive range in just a few years. So going forward, we do expect that we're still going to see plenty of that volatility. If we think back to what that standard deviation was of $134 a short ton, that will come into play. As it is right now, our forecast for 2019, we have hot rolled coil averaging $688 a short ton, and then in 2020 it averages $700 a short ton. In 2023 it gets back towards $635, so nearly back to that 15-year average at $623. The next slide that I have helps to provide a little bit more information in terms of that forecast. So I have our forecast listed as the dotted line, and we can see that prices are elevated a bit in terms of that overall spread of the max and the min. The max and min are built they're built based on the standard deviation over a couple different areas. We have the global spread plus the 25% from the Section 232. So those provide a higher upwards bound level and a lower bound level. This is the final slide, but what we're looking at is what factors will lead to continued price volatility. And these are some of the really important factors that we're looking at as the forecast progresses here. We're looking at a slower growth rate of industrial production and an increased chance of recession. Generally, as industrial growth increases or slows, even if it's positive and it's still slowing, that will have an effect on inventory changes, and that will have an effect on the market. We also have trade issues that are driving some of that slowdown in industrial production growth. I think last year the number in the U.S. was growth year on year of 4%, 3.9 or 4%, and then this year it's set to drop to about 2.5%, and then under 2% next year. So that's a significant decline. The second issue here is increased North American hot rolled coil capacity. We have identified 18 to 20 million tons of new hot rolled coil capacity coming onto the market, and that will have a shock to the market, to the system. So what that will lead to is a little bit wider spread, at least initially, for cold rolled over hot rolled, but it will work to depress prices in the U.S. The third bullet point here is increased competition among steel producers. So not only do we see higher capacity coming onto the market, we're also seeing more independent steel producers that are going to be fighting for market share. And this is kind of an understated point, that in the past you had other producers such as RG Steel, ThyssenKrupp, Severstal, Gallatin, CSN. They either went away or they were acquired and merged into other steel mills. Now we have some new independents out there with Big River Steel as a new greenfield producer. Stelco is branched off from U.S. Steel in Canada. Then you have JSW Steel has restarted an old production facility and is working to expand that. So that is a struggle as well. That does lend downward pressure to our price forecast, as well as increase the volatility in the market. And then next to last is the evolution of the Section 232. We see the evolution pretty clearly right now that there should be some relief for Canada and Mexico based on the new NAFTA agreement. We don't know exactly when that will come, but we think that's here very much in the near term, in the next few months. Other than that, there will be other exclusions that will inevitably come out from for steel producers, as well as possibly some other countries with trade agreements. You will see something from the WTO. There's further challenges to the whole policy. The whole 232 could go away with the next administration, whether that's in the next presidential cycle or the one following. And then lastly, and maybe more importantly, is the political pressure on the Section 232 as the economy slows. As we forecast slower growth in the economy, we're concerned that, much like the Section 201 back in 2002, this policy may coincide with this trade war that affects manufacturers that are able to move steel-intensive goods offshore. So we may see further shutdowns of some manufacturing facilities, loss of jobs, and that may lead to political pressure, which in turn may weaken the Section 232 further. The only thing in our forecast right now is Canada and Mexico coming back into the fold with some sort of exclusion. The other ones, as they come in, if they come in, and to what extent they come in, that will affect our forecast, and it will certainly affect the volatility in the market. And then the last point here is just the black swan. It's the extreme impact of rare and unpredictable outlier events. This is something that you can't predict. It's an unknown unknown. The way this works to volatility is it's not only a downward pressure, but it's also an upward pressure. Whether there's some sort of production issue that limits capacity, or there's some other issue that comes out and it weakens prices dramatically. So these are some of the key factors that we're looking at in terms of the volatility. But overall, that's what drives prices. And if we could go back just to the prior slide, I can end here, where, as I said, the forecast is in the dotted line. Likely there's downward pressure on prices, maybe more so in the near term for sure, but longer term as many of these events unfold. But there's quite a large range here. As I said, it goes back towards that range from 2015 through 2018. So this should capture the vast majority of movement. It's just a challenge to forecast exactly what price goes where. That's the conclusion of my slides, and I'd like to turn it over to Sean.
All right, thank you, Josh. Just before you do, I just wanted to point out, it's difficult, isn't it, for us to forecast sort of month-on-month or week-on-week price volatility. But I think the high and low here on this slide are really revealing. That analysis shows, the kind of range that, the price could occupy, although obviously we believe our forecast, it is difficult on a short-term basis to factor in show on a chart that volatility. All right, thank you, Josh. I'm sure we'll come back to you for questions at the end, but now I'd like to turn over to Sean at the CME. Sean has a number of slides on the services and the value-adding function CME can provide. So Sean, over to you.
Thank you, Chris. Thank you, Josh. Before we get started, I'm just going to take a minute to introduce everyone to CME Group for those who might not be so familiar before we get into using futures to hedge price risk. Before I jump into it, just quick disclaimer here on the next slide. Exchange-traded derivatives and cleared over-the-counter derivatives are not suitable for all investors. They do involve a risk of loss. So on the next slide, CME Group. Who are we? CME Group is the world's leading and most diverse derivatives exchange. It's where companies, institutions, and individuals from around the globe come to manage their business risk, hedge against fluctuations, and protect themselves against price volatility. CME Group is one of the world's largest derivatives exchanges. We handle 3 billion contracts worth approximately $1 quadrillion annually, kind of an absurd number. We have benchmark contracts across all major asset classes, includes everything from interest rates, FX, metals, energy, and agriculture products. Today, I'm responsible for managing the CME metals contracts. If we could just flip to the next slide, please. And at CME Group, we break down our metals futures contracts into 3 main categories. We have base, which essentially is our copper, alloy, zinc, and lead. We have precious products, which are benchmark gold, silver, platinum, palladium. And we have our ferrous products, which includes our suite of various different steel products and iron ore. Today, we're specifically going to be talking about the U.S. Midwest hot rolled coil steel futures and options contract, which settles against the CRU index. So on the next slide here, we're just going to take a quick look at how volume and open interest has grown quite substantially in our HRC futures contract. So the kind of navy blue histogram bars here represent what we coin average daily volume. It's exactly as it sounds. It's the average amount of contracts that are traded per day over a given period. In this particular instance, we're using the quarterly increments in order to show this growth. And as you can see from the chart that there has been stark growth in average daily volume and open interest in these products. And this simply represents that people are starting to use this contract to trade more, to hedge out price risk. It potentially displays how more market participants are coming in and existing market participants are using more of the futures contracts to hedge out that price risk. We saw a nice growth from 2017 to 2018, where in 2018 we kind of hovered right around that 500 average daily volume mark, and then we saw a surge in liquidity this past quarter of Q1 of 2019, where we actually broke to the highest record on level above 800 contracts on average per day for the quarter, and open interest surged above 19,000 contracts. Open interest is the number of contracts or commitments outstanding in a futures and options contract that's traded on an official exchange at any time. One thing to note is that many folks along in the steel industry, along the supply chain, they have tendency to speak about steel in terms of tonnage. So one contract of CME hot rolled coil futures is equivalent to 20 short tons. It's kind of shown in that top right of this chart here. So we represent average daily volume in contracts, and then to convert a contract into tons, it's just one contract equals 20 short tons. Our futures contract is quoted in US dollars and cents per ton, and the minimum price fluctuation is $1 per short ton. So a $1 change in a CME HRC futures contract is equivalent to $20 because of that contract unit size of 20 short tons. You also hear people say that the contract is financially settled, or they'll say it's cash settled. And this means that the contract, there is no physical delivery of this contract. It is cash settled, and it settles to the average of the prints published by the CRU US Midwest Domestic Hot Rolled Coil Steel Index. We also have options on the futures contract. So your futures contracts are going to be referred to as HR, HRC, and our options contract code is HRO. You can just think of that like HR options. So on the next slide, talk about why trade HRC steel futures. Trading HRC steel futures can help price be managed separately from physical supply. HRC steel futures and options can be used as a cost-efficient hedging tool to protect profit margins and minimize risk. So far in this discussion, we've chatted a lot about the increased volatility that has come into the U.S. steel market, particularly within the last year. And this chart here kind of just shows how the CME hot rolled coil futures contract has fluctuated pretty sharply, particularly over the course of 2018. That's why we saw an increased emphasis from market participants getting set up to trade, trading more liquidity, trading more volume, and hedging out that price risk. Either they're being opportunistic and taking advantage of higher prices, or they are now seeing that there's volatility back in the market and they would like to hedge out that price risk to manage their future deals perhaps. So on the next slide, I'm going to talk about who is trading HRC futures. So really, the short answer is that folks from all along the supply chain are now trading CME HRC steel futures, and that also includes folks in the finance department. So it's like the investors, banks, and hedge funds. So to the left here, again, another histogram chart that just shows the unique participants that have started to trade CME HRC steel futures, and there is pretty significant growth percentage-wise from 2015 to 2016. We saw moderate growth in 2017. Again, this explosion of growth in 2018, where we saw a flooding of new participants getting set up to trade and placing their first trade in CME HRC steel futures, particularly around the increased volatility that we saw. On the right here, I have a pie chart, and now the data that is supplied, that provides the data for this pie chart, is the CFTC. It's a Commitment of Traders report. The CFTC publishes Commitment of Traders reports across various different U.S.-based derivatives contracts. So for example, a Commitment of Traders report is available for copper, gold, and silver. It's also available for hot rolled coil steel futures, and it's published weekly. And what it does is it kind of gives an indication of who the open interest holders are in this product. And the real interesting takeaway here is that the category which CFTC defines as producer, merchant, processor, user, those folks are typically your commercial or corporate firms that are dealing with physical steel every day and are using CME steel futures to hedge out price risk or lock in profit margins or to offer fixed price deals to their customers. And those folks represent 48% of the open interest holders of CME steel futures. The other two interesting takeaways is that managed money, as of the end of March, as of the end of Q1 essentially, managed money represents 30% of the open interest holders. Managed money would be typically your hedge funds or asset managers. And it's these types of firms that are providing the liquidity for the commercial firms, the corporate firms, the producers and merchant processor firms to find the liquidity they need to hedge out the price risk. The other interesting takeaway is that swap dealers represent about 13% of open interest holders. Now, this can be a bit murky in how the CFTC defines a swap dealer, but you can think of these folks like other financial institutions, like banks, for example. And then along the bottom here, I just broadly listed the types of firms that are trading CME steel futures. And as I said, it's from all along the supply chain, anything from producers to merchant traders, all the way to scrap processors and recyclers. So on the next slide, I'm going to talk about how are people trading CME steel futures. There's really two main methods of how people are accessing our markets. The first is electronically. This is through a front-end trading platform. So, for example, CME Direct we have our own front-end trading platform to help folks access CME markets. And this is when you hear people say they trade electronically or on the screen, it's they're using a front-end trading platform to actually point and click and execute trades on their own. The other method that folks are using is bilaterally agreed. This is very relationship-based trading. They're using brokers and banks. As an exchange, we're very agnostic to how people access our markets. In fact, I personally encourage people to entertain and access both methods. So I would suggest you get a screen and you give yourself the availability to view prices in real time, see where things are trading in the forward curve, and inform yourself. So that way when you're negotiating bilaterally with brokers and banks, and these are very educated professionals who have a lot of experience in steel, the steel markets. They have clientele from all along the supply chain, so they really can be a wealth of knowledge, and they can help you source liquidity and structure unique deals, and they can provide insight into how you hedge. So I really encourage folks to use both methods. And the screenshot here is of CME Direct as of early April, and it's just an example of how you can use the electronic screen to gather insights and to inform yourself. And you can see that prices are quoted out for the futures curve all the way to April of 2020, with trades in this particular instance out to March of 2020. You can see the amount of volume that is traded. You can see the amount of open interest in contracts. And then to the right, I'm just showing this mobile phone, which is of a chat platform, because that's typically how people are bilaterally agreeing and trading in a relationship-based style, is via the phone, email, and chat. So I know this was quite a bit to consume. So on the next slide, I just wanted to offer some resources. You can visit our website, cmegroup.com/Ferris, and from there I would encourage you to click around. There's a vast variety of material there where you can educate yourself on specific products we offer. You can find hedging examples. You can even get to our education page, which will have trading simulators so you can trade in a mock environment. Feel free to contact me directly. My email address is listed there. You can contact the Metals Group if you have more broad questions or just anything. Would be very receptive. And I would also encourage you guys to connect with CME Metals on LinkedIn. We're constantly publishing market insights for all things metals related, and it's a simple way to kind of stay in touch with what's happening in the metals markets or with our specific products. And with that, I'll pass it back to you, Chris.
Great, thanks a lot, Sean. That was really informative, and it looks like, you know, serious momentum being built up in these contracts settled on CRU. So it's really good news, and it's obviously a really great function for the market. So I'd like now maybe just to turn to some of the questions which the participants on this webinar have been asking us. And we've got quite a few here, so we're not going to get a chance to cover all of them. But firstly, for Josh, maybe we can start with something around the physical market again. And the first question here we've got from a participant on this webinar is, can you address the change from US tariffs to possible import quotas? So the situation is not certain, but in the instance where a tariff changes to a quota, what's that going to mean, Josh, for the market and prices, I guess?
Sure. Yeah. Thanks, Chris. And thanks for that question there. Certainly, as the Section 232 evolves, one option that continues to be discussed with Canada and Mexico is maybe not a full exclusion, but perhaps and it's been offered to them, but maybe they elect to take some sort of quota. And whether that quota is like what's agreed to with South Korea, where it's only 70% of historical shipments, that's not going to make much sense. I think it'd be more along the lines of 100% of some recent historical shipments. Regardless of where that is, though, I think what you're going to see, though, is noticeably increased volatility strictly because of that. And we've seen it in the example of South Korea. Their import arrivals that come in, they're front-loaded by the quarter. But more so, I think we've seen it with the slab imports from Brazil, where a number of companies, not just re-rollers that had relationships with Brazilian slab producers in the past, but other re-rollers that have taken advantage of more of a market price of slab. So we've seen with the first month of each quarter a dramatic increase in slabs, and we've seen the same sort of thing in Europe as well, where there's some new restrictive quotas on some products. And so I think that the answer is it's going to lead to much higher volatility throughout the year, not just on these cycles of multiple months, but it's going to be some drives upwards, and then prices will inevitably come back down as some of that material is processed and released into the market.
So Josh, the next question I've got coming in for you here is around price spreads between hot rolled coil and cold rolled coil, and also between hot rolled coil and plate. So the question is, will the plate versus hot rolled coil spread close to sort of normal levels, in inverted commas, as in the historical trend seen before 2019? What's your forecast for price spreads?
Right. Yeah. Thanks. That's an interesting question, and I think there's two areas that it's really looking at. Not just the spread of plate over hot rolled, but also cold rolled over hot rolled. I talked about that, I think, a little bit, the cold rolled one, where we're expecting a little bit wider spread than what we've seen recently or even historically, as we see more hot rolled come into the market in terms of capacity, and not as much cold rolled coming in. So I think those spreads they're apt to widen a bit, and we've seen that recently. I think the most recent one this past Wednesday was 140, and that's in our forecast that it's closer to the 140, 150 in the near term, and over the next 6 to 12 months it starts to drop back down towards 135 and then 130, maybe a year and a half, 2 years out. In terms of plate, plate is a tricky product to forecast the price of, because I go back and I look at comparison prices, the spread of plate over hot rolled. Historically, I think it's close to 120, but it's had a very wide range. It's gone negative to hot rolled. It's higher than 300 over hot rolled. You can see the spread of plate over an Asian import price, the spread of plate over scrap, and it's very, very volatile. Plate is a tough market to forecast, but in our forecast, what we have is that spread is going to come back down. The differentials between plate and hot rolled coil is hot rolled coil reached a peak in July, and then it dropped by $251 into early February after it reached that peak. Plate reached a high in August, I believe, and it remained up near $970 for the next several months before it started to come down. We are seeing plate come back down, and our forecast does have it coming back down towards a more historical spread, but again, with new capacity with hot rolled, that spread is not going to be as tight as 120 as it was in the past.
All right, Josh, thank you for that. One more question for Josh, and then a question for Sean. So here's a good question, quite maybe a little bit provocative perhaps, but Josh, what are your thoughts on service center behavior amplifying short-term price volatility, perhaps even more than supply-demand changes might otherwise indicate? What's your view there?
Right, Chris, I think you mentioned something in your presentation about the mismatch of supply and demand and how that leads to some price volatility, and we certainly see that when service centers get involved. The way that they work is they have their outgoing shipments, and their shipments will fluctuate alongside demand and seasonal activity. And they carry a certain amount of inventory to support that demand. As their demand starts to rise, they need to increase their inventory, and really that's a multiple of demand. So if you just give it a good round number of, say they need 3 months of supply, and their demand rises by 20% because of seasonal factors that are then supported by structural factors, their inventory levels, when they thought it was 3, it may have only been 2, so they need to ramp it up much more quicker, and that is truly what drives volatility in the market that we've seen since 2004, and really, if we were to go back to that price chart that I had since 1980, it's a driver of volatility everywhere. So the service centers, yes, they do play a very key role in volatility in the market.
All right, thank you, Josh. We're a little bit up against time, but there's an important question here for Sean, and I suspect this is to some extent being covered in what's already been said, but it's so important I'm going to ask this question, which is, if, as CRU forecast, price volatility continues for the foreseeable future, how can a steel producer or an end user or processor hedge this risk? And I think this is getting to, what are the practical next steps with regard to
Sure.
CME contract?
Well, the first thing that comes to mind to answer that question is I just encourage people to just be in position to trade if and when the situation arises that you need to. So you don't want to see an opportunity to hedge out your price risk or wait for a market event, and if you're not ready to hedge, it's going to take time in order for you to get set up. And by get set up, I mean like you have to set up a clearing account. It doesn't take long. Many firms in the steel industry already have relationships with financial institutions that can do this for them. So I always encourage people, get set up with a clearing account. I can help make introductions to the brokers and banks that cover the space, so we can get those types of relationships in place, and that way they have the contact details, they're getting information flow, and we can set them up with an electronic screen with CME Direct. That way, when the situation arises, they're prepared. They can either choose to use brokers and banks, they can choose to trade electronically, and if the situation never arises, in the very worst case, they're prepared for when it does, and they're more informed with what's happening in steel futures than they may have been if they never had done that. So it's really 3 simple steps, and all it takes is a little bit of proactiveness to do that. And then I would encourage people to use CME as a resource. We're constantly putting out education material. We have hedging examples and documents that I'll be happy to share with anybody who's interested. We have an education site within CME Group's website where you can access trade simulators and learn about how the products work, and take courses on options trading even. And then I would just say the last suggestion would be like, know your goals, like know what your desired outcome is, and know what you'd be happy with if you did hedge and that outcome in the best case and worst case scenario happened. And then when you have those things defined and you're set up to hedge, well then you're prepared and you can remain opportunistic and wait for that to happen. So I'd be happy to help anyone offline kind of get set up to trade, even if it's not something they're going to do in the imminent future, if it's something that they just want to be prepared for if and when the time arises that they need to do it.
All right, Sean, thank you very much for that answer and the question, of course, in the first place. So we're nearly out of time, but there's just maybe 30 seconds for me to mention to you that CRU will be in New York on the 17th of June this year with our usual steel seminar. We've got some great speakers there, including Lewis, trade attorney. Many of you know Lewis Lebowitz, and John Packard, part of CM Steel Market Update, part of CRU. So if you're in New York, in that week, which is a key week for anyone in metals, please do register and come along, and you may likely see CME partners there as well. So just a little plug for that. Finally, thank you very much to Josh, thank you very much Sean at the CME Group for this webinar, and we look forward to engaging you in the future in your physical and financial contract needs. Thank you.